Good morning, everyone. Can someone please confirm if you can hear me? Awesome. Thank you. Thank you. Okay, I think it's 11 o'clock on the dot. So on behalf of the entire team at FCSL Asset Management, we'd like to say thank you for joining us on this important engagement this morning. We'd like to say we appreciate you and we're grateful that you've taken time out to join us on this special webinar we'll be having today. So just to provide some overview of who we are and what we do, for us at FCSL, we like to describe ourselves as a capital market conglomerate. We're duly licensed by the Securities and Exchange Commission as an issuing house, as a broker-dealer, and also as a fund and portfolio manager. Our services cuts across institutional clients, retail clients, both HNIs and ultra HNIs. But for us this morning, our conversation is a very important one. And I believe as investors who are here on this important meeting with us, I believe it's a burden that has been on your chest. We have seen a lot of discourse have been held on this topic, which is a capital gains tax. And so for us as a firm, we deemed it important that for our esteemed clients, our esteemed prospects, that we have this engagement for us to provide some insights on what these new tax reforms, particularly the capital gains tax, its impact it would have on our portfolio, on your investors' wealth as we go into 2026. And so that's why we're having this engagement this morning. And we believe that at the end of this engagement, we should be able to provide some practical understanding of what the capital gains tax will be. We should be able to give you some impact, some idea on what its impact will be on investors' wealth. And also, most importantly, the advantage that this might create as a result of this policy shift that has happened. And also, finally, we also know that there are some gray areas around the capital gains tax and its implementation. To a large extent, we'll be able to highlight some of those gray areas. And as the government has stated, hopefully they should finalize on this before the end of 2025, going into 2026. And some other important information which we believe will be beneficial to you on this capital gains tax and your investment portfolio ahead of 2026. And so to do discuss on this conversation this morning, to do justice rather on this conversation this morning, we have our keynote speaker, a very distinguished one for that matter. His name is Mr. Adeboye Sonya-Olu. Mr. Adeboye is a seasoned chartered accountant and a tax advisor with over 15 years experience, robust experience, I must say, which cuts across the financial services industry, the oil and gas manufacturing, FMCG sector. He's currently a senior manager at Creston Pedabo, an institution that has cut its teeth in tax advisory in the financial service space as well. He currently leads the tax advisory and assurance engagement at Creston Pedabo. Mr. Adeboye is renowned for his expertise in cross-border tax matters, corporate restructuring, resolving high-value compliance issues. He's a dedicated problem solver. Over the years, he has structured tax compliance issues with ever-evolving legislation around optimizing what tax positions are. He's a fellow of the Institute of Chartered Accountants of Nigeria. He holds an MBA from the Obafemi Awolowo University, also a BSc in Economics Education from Olabisi Onabanjo University. He also has a diploma in International Financial Reporting from the ACCA. And so we are grateful to have Mr. Adeboye this morning speak to us on the capital gains tax and its investment portfolio and your investment portfolio in 2026. My name is Omoefe Tiger, and I'm going to be moderating the session this morning. Once again, I'd like to say welcome, everyone. We appreciate you and we look forward to an exciting engagement. Mr. Deboye, I don't know if you can hear me.
Good morning, Tiger.
Thank you. Thank you.
I can hear you
Awesome.
loud and clear.
Awesome. Awesome. So I'd like to leave the floor to you.
Okay, thank you, Tiger.
Thank you.
And good morning, everyone. Can you please confirm you can hear my voice?
Yes, we can.
Okay, and you can also see my screen.
Yes, I can.
All right. Thank you very much once again, and good morning, everyone.
Okay, Mr. Deboye, can you just put your slides on full screen on the PowerPoint slide mode? Right. Thank you. Awesome.
All right. Thank you, everyone, for joining. I must say, I'm glad to be the presenter at this webinar. So, of course, we are all. I'm getting some interference from somewhere.
Yeah, I think you can go ahead.
All right. Thank you very much. So I think our discourse today centers around capital gains tax and your investment portfolio in 2026. This couldn't have come at a better time. We are all aware of the recent tax reforms in Nigeria, where the whole tax framework has been reformed from the tax administration, the tax legislation themselves, and so on. So come 2026, there's going to be a new framework for taxing individuals and companies on their profits and gains. So, and of course, this has also brought in some uncertainties, apprehensions across markets, across taxpayers, even across investors, to the extent that we experienced or we saw how there was a decline in market capitalization on the Nigerian Stock Exchange, NGX, in November 2025 rather. So I believe most of these apprehension and uncertainties, we are here to clear and to provide certainties and clarify every issue or criticism that surrounds the tax legislations. The tax reforms introduced four new tax laws or four new tax legislations. Okay, the Nigerian Tax Act, which includes the taxation of income and profits for both individuals and corporate. Then we also have the Tax Administration Act, which talks about how the tax authorities are going to administer the assessment, collection of the taxes. The other two are the Joint Revenue Board Act and the Nigerian Service Establishment Act. So, but our focus today will be on the Nigerian Tax Act, wherein there are provisions for taxation of chargeable gains. And the chargeable gains we're going to be talking about are going to be strictly about shares and securities. So we're going to look at the history of capital gains tax in Nigeria, uh, looking at the evolution and the amendments that it has experienced up until 2025. We'll talk about the provisions of the capital gains tax. What are the new requirements? What are the new provisions going forward for 2026? And compare these changes with what is currently obtainable under the Capital Gains Tax Act. Then we'll try to talk about tax strategies uh, to reduce or mitigate the effect of the increment in the tax rates for chargeable gains. Many people are afraid already that the tax rates are being moved from 10% to about 30% for companies and 25% maximum for individuals. So we'll look at discussions around that area. And of course, there are tax vehicles or investment vehicles that investors could make use of so as to reduce your tax exposure on taxing capital gains. Then lastly, we'll talk about what compliance is required of us from the type of reporting and also provide advisory on best practices. So capital gains tax is not new in Nigeria. It was first introduced in 1967 via the government, via the federal government decree. At that time, the tax rate was 20%, and it was only applicable to the Federal Capital Territory of Lagos. It wasn't across all states. It was only in Lagos that it was applicable to at that time. But over the years, from that 1967, we have seen changes in the provisions of the capital gains tax that, based on economic needs to encourage investment and capital formation, there's been several changes. Then, of course, capital gains tax relates only to chargeable assets, that is, gains that accrue from disposal of chargeable assets. These assets include properties, land and building, and so on, options, shares, debts, digital assets, such as cryptocurrencies and others. Then, of course, other currencies aside from Nigerian currency. So the aim is that when there are disposals of these chargeable assets and they make a gain, then capital gains tax will become liable. So it's not only limited to where assets are being disposed, okay? Even in cases where assets were not acquired and there is a receipt of a capital sum, capital gains tax will also apply. And this will occur in instances where an employee receives an amount of sum which is for compensation for loss of employment. So when an employee receives any amount, currently 10 million naira and above, that's liable to CGT. And of course, in instances where there is an insurance payout under an insurance policy against injury or loss of assets, you will also be liable to pay CGT. Then when you receive a sum in return for forfeiture or surrender of rights, CGT will also apply. So these are other instances where CGT will apply aside from where you dispose of an asset. So, like I mentioned earlier, uh, the CGT was actually introduced in 1967, okay, and it applied only to the Federal Capital Territory of Lagos. At that time, the rate was 20%, but over the years, in 1998, there was amendments to that CTT Act, and the rate was reduced to 10%. And at that time, it was now expanded to cover every state in Nigeria, not only the Federal Capital Territory. So, of course, it was believed that the rate was reduced to encourage investment in the capital markets. At that time, as you see, show you the market capitalization from 1998 to 2025. So it was introduced to encourage investment in capital markets and, of course, capital formation. At that time, up to 2004, the Nigerian economy was experiencing or was about different reforms from the banking sector reforms, privatization, and recapitalization. So, of course, we saw such reforms. And in 2012, there was an income tax exemption order that exempted income or profit from federal government bonds, state government bonds, and corporate bonds. That expired in 2022. And I must also mention that there was another amendment via the Finance Act 2021, which now reintroduced the tax on disposal of shares. I mentioned earlier that in 1998, there was an introduction to exempt tax on shares. That happened up until 2021. In 2021, the Finance Act was introduced to remove the exemption on taxation of shares. Up until 2025, where we now have the most recent amendment, total overall of the Nigerian tax reforms, and I will be focusing on those reforms in a short while. So we see that from the development of the capital market, the screen shows the market capitalization from 1998 to 2025, current year. Okay, you mentioned earlier that in 1998 there was the introduction of the CGT exemption. Okay, and that increased market capitalizations up until 2004, where the economy was the government tried to boost the economy with privatization, liberalization, and banking sector reforms, and so on. The stock exchange, or the NGX, experienced the highest ever in 2008 with over 100 billion US dollar capitalization. Then from 2008, the whole world experienced the global financial crisis. Nigeria was not left out, and the markets cap dropped. That happened all over the world. Then other amendments or other occurrence in the capital market is the tax exemption order in 2011 that exempted income from bonds, state government and federal government and corporate bonds. And I also mentioned that in 2021, we had the Finance Act, the exemption that was there on CGT was removed. And from 2021 up until now, there has been taxes on shares. So we have seen that from that 2021 even up until now, despite the removal of the tax on exemption of shares, the market capitalization continued to grow up until 2025. Then in November 2025, we saw that there are reports that the market capitalization dropped about 6 trillion naira in just a month, the highest ever since January 2013. Probably this drop could have been as a result of the fear or the uncertainties as to the implications of the CGT from 2026 going forward, or in some quarters, as some people have reported, that it may also be a result of the announcement by the US president to come into Nigeria guns ablazing. So those recent happenings as regards to the Nigerian capital market. So this narrates the graph, the pictorial representation I discussed earlier. So just to add to that, effective January 2026, the Capital Gains Tax Act will be repealed, and the Nigerian Tax Act will come into place. Okay. In the Nigerian Tax Act, one thing that has changed is that for corporates, for companies, income tax and capital gains tax are now aligned, that will be taxed together as one. And the tax rate is 30%. The same applies for individuals. Your income taxes and your income profits from income and profits from capital are also aligned and will also be taxed as one tax rate, depending on your tax rate as an individual. This could range from 0% to 25%, 25% being the highest tax rate for an individual. So let's talk about the capital gains tax, as provided in the Nigerian Tax Act. Please note it is no longer a capital gains tax, okay? Rather, they are referred to as chargeable gains under the Nigerian Tax Act. So currently, we all know that the rates for taxing chargeable gains, including gains from shares, is 10%. Okay, and one of the major clamor or criticisms from investors and other taxpayers is from 10% to 30%. What a huge jump! So taxes are going to increase. Of course, there is also losses. So of course, when you also have disposals that result in a loss, you're also expected to take advantage of those losses. You use your losses to reduce any capital gains tax you make from disposal of assets. So the government is not only taxing your gains. Wherever you make a loss, you take a relief for that. So other changes are as it relates to non-residents. Non-residents are not exempt from paying capital gains tax or chargeable gains in Nigeria, where they also make chargeable gains. So under Section 46 and 47 of the Nigerian Tax Act, there is an anti-avoidance provision wherein that it provides that where there are indirect offshore transfers or foreign share disposals that are not directly Nigerian disposal of shares, such disposals will be liable to chargeable gains in Nigeria. Okay, in as much as the value of the assets being disposed or the shares being disposed has a 50% or better than 50% derivation from Nigeria. Okay, what I'm saying here is that if, for instance, two companies outside Nigeria, maybe one in USA and one in Mauritius, the USA company wants to dispose or disposes of the shares in the Mauritius company. Now, on paper, you would expect that this has nothing to do with Nigeria, okay? But what happens when the Mauritius company now has 100% control or 100% ownership of an asset in Nigeria or a share in Nigeria from which it derives more than 50% of its value? Now, what the tax law is saying is if such arrangement exists or such transaction exists, and an asset or a company outside Nigeria has been disposed, and that company has ownership interest in a Nigerian entity, such gains from disposal will be liable to uh, tax in Nigeria. Now, I mentioned it's an anti-avoidance provision. Okay, such arrangements are designed to avoid paying tax in Nigeria. So these provisions have been introduced such that when such transactions occur, then the taxes are going to be liable in Nigeria. So what are the implications for both individual and corporate or institutional investors? I've mentioned earlier that the tax rates will go from 10% to 30% in the case of companies. Then for individuals, it will go to range from 0% to 25%, depending on your income tax bracket. Okay, individuals earning a higher income have a higher tax rate of 25%, while those earning lower income ranges from 0 to 15 and 18% as we go on. So one other critical thing to note is that there is still exemption for income from government bonds. So in addition to federal government bonds, state government bonds are also exempted from income taxes and CGT. So for those people that may want to uh, avoid paying taxes, depending on your return appetite, you might consider investing in tax-free government bonds. Okay, there are some exemptions to the taxation of chargeable gains. Okay, not all the time that you make a gain, then it becomes taxable. So currently, under the Capital Gains Tax Act, where the sales proceeds from your disposal of assets is less than or equal to 100 million naira, then such any gain you make from that disposal are not liable to CGT. Okay. Then under the Nigerian Tax Act, that threshold has been increased from 100 million to 150 million. So any proceeds you make that is less than or equal to 150 million will not be liable to CGT. And of course, where the gain is also less than or equal to 10 million naira, both conditions have to be met. Then you will not be liable to pay in CGT where these conditions are met. Then also there's a condition for reinvestment. Anytime you reinvest your proceeds, if you reinvest 100% of the proceeds, then total amount, any gain you make are also exempted from CGT. If you only reinvest a portion, then the gain that is related to that portion will be liable to CGT. Then the third exemption is sales in a regulated securities lending transaction, where shares are being exchanged in a regulated securities lending transaction. Such transactions are exempted from chargeable gains under the NTA. So investors, individuals, corporates, there have been criticisms of these new CGT rules. And the government has also provided some responses, even though we can't say that the responses have any legal backing yet. But the criticisms range from the increase in tax rates from 10 to 25% and 30% for individuals and corporates respectively. The new provisions and the increment in tax rates poses a risk or disadvantage for certain investors like venture capitalists and private equity funds. Even though for venture capitalists and private equity, they have some exemption if they invest in a Nigerian labeled startup, and that they hold such investment for nothing less than 24 months, any gain they make will be exempt from CGT. Then there is also the possible negative impacts on foreign investors, okay, whose gains may not be real due to Naira depreciation. The Naira was depreciated in 2023 and up to now. So for some people that have brought, for some investors that have brought in foreign currency and invested at that time, so even if they have made gains on their Naira equivalent, the Naira equivalent gain does not necessarily mean that they have made gains in their foreign currency. So that's the impact of the depreciation. So those foreign investors may be really aggrieved at this point. Then, of course, Nigeria, the 30% rate is one of the highest in emerging markets. I think only Mexico has higher than 30%. Other countries, India, South Africa, and the rest have 30%. So this may impact Nigeria's competitiveness amongst emerging economies or emerging markets. Then there's also this concern for retrospective application. Okay, the Tax Reform Acts are expected to take effect from January 2026. But the question is, the effective date, is it going to consider transactions from 2026 or it is going to consider transactions from 2025? So we expect the government, the government, the Ministry of Finance or the FIRS to come up with this, with clarification on this date of application, because usually what would happen is that for corporate, corporates are taxed on the preceding year basis, meaning that the income and profits of 2025 will be taxed in 2026. And if we are saying that the law takes effect from 2026, will it apply to incomes of 2025 or 2026 going forward? So we expect clarification in those areas. Otherwise, it should be expected that any gains that was made in 2025, the tax rate will now be 30% instead of 10% as we currently have. So I think the Minister of Finance made a comment when there was this drop in market capitalization in November 2026. And I think there was a forum where he addressed the public and investors and mentioned that the government has heard the criticisms and they're looking into it. And hopefully they will come out with guidelines or a form of guidelines or additional clarification as to how these criticisms will be addressed. So that's on one side. Then on the other hand, we also had comments from the chairman of the Presidential Fiscal Reform Committee, Taiwo Edele, where he mentioned that the gains preceding 2026 will be grandfathered or ring-fenced. This, what it means by that is that the cost of any gains on shares will be the cost as at 31st December, not the cost as at when it was bought, maybe 1 or 2 or 3 years ago. So with this, it is expected that if the cost is now rebased as at 31st December 2025, then the impact of the tax rate will reduce because the cost as at 2025 will not be the market rate, which will reduce the margin or the profit between the sales proceeds and that cost. So those are comments from the government representatives. So let's look at areas of strategic planning and portfolio structuring. Number one, we mentioned that government bonds, federal government and state government bonds are still exempt from income tax and chargeable gains. So you might consider mixing your portfolio or including your portfolio securities from government. Then, of course, we mentioned earlier that disposal of shares that are below the threshold, which is 150 million naira proceeds and 10%, 10 million naira gains will also be exempt. So for individual investors that do not have so big a portfolio, they would enjoy this exemption. Then another thing is aligning the timing of asset disposals with period of lower taxable income, or when the gain can be offset against carry forward losses. I mentioned earlier that where you have losses from disposal of shares, the losses can be net off from the gains that you make on disposal of shares, such that not only the gains will be taxed, then by deducting losses, you have a reduced amount of gains that will be liable to the tax. So it's very important that you consider when to dispose of your shares so as to take advantage of any losses that may accrue to you or that you currently have as an investor. Then, of course, it's also important to balance growth with tax efficiency. Most investors only consider the pre-tax profits or pre-tax returns of their investments or of their shares. Now it is more important that you consider the after-tax returns, because the after-tax returns, with a tax rate of 30%, really, it's important that consideration is taken for the after-tax impact of your returns before you make your investment decisions. Then, of course, structuring portfolios to include a mix of taxable and tax-exempt instruments. Then determine the best point of disposal or investment to set up deductible costs. Then harvest your tax losses. You could do this by selling underperforming stocks to reduce your taxable gains from high performing stocks. Then there's also the possibility of spreading investments among multiple beneficial owners with lower effective tax rates. This is in contrast to holding the investment in the name of one person. Supposing contrasts investing 1 billion naira in stocks as a person, rather than investing it over 10 or 20 different people. So with that, each person has a lower effective tax rate. So there's a possibility of reducing your exposure to chargeable gains with that option. There are also investment vehicles that could offer tax advantages. Number one is the mutual funds and collective investment scheme. Okay, under the Nigerian Tax Act, earnings by authorized collective investment scheme, that is authorized by the ISA Investment and Securities Act, are exempt from income tax at the fund level. Any income those schemes make at the fund level are exempt. Okay, while distributions to unit holders are treated as dividends, which are only taxable at 10%. So you might also consider running your investments through collective investment scheme. I mentioned investment in government bonds earlier. So for those that are not averse to tax, that enjoy tax-free income and certainty in returns, you may consider investment in government bonds. So to navigate the provisions of the NTA as regards chargeable gains, there are some compliance and compliance requirements that is required. Okay, number one, Documentation is highly required. You would need documents to support your acquisition costs, asset improvement expenses, disposal proceeds of the assets, and also evidence of reinvestment if you have to claim the advantage or any exemption from chargeable gains. Then filing requirements. Individuals are required to file their tax returns by 31st of March every year. And companies are also required to file by June of every year following the year of accounts. That is for companies that have December year ends. Then common pitfalls to avoid. Failure to maintain adequate cost documentation. Without adequate cost documentation, you will not be able to claim costs, you will be able to claim deductions for the costs relating to your disposals. Then misclassification of taxable gains as exempt income. Okay, as taxpayers, you need to be able to differentiate or identify which incomes are exempt and which ones are taxable. Then omission of indirect asset transfers, that's relating to non-resident entities. Okay, non-resident entities are also captured now, so it's important that they are aware of these provisions. Then late remittance of tax due on realized gains. Of course, there is a role of professional consultants, professional tax consultants, and financial advisors. Number one, regulatory compliance to ensure accurate interpretation and application of the tax provisions. Okay, this is done through awareness, advisory, and so on. Then strategic planning. We also advise clients on tax efficient structures for asset acquisition, financing, and disposal, all to minimize the exposure to taxes. Documentation and reporting. Tax consultants, professionals with investors and corporate alike are expected to have proper and complete documentation and reporting. Then transparency. You need to support all your claims, your incomes, your deductions with full disclosure to the tax authority. So what are the key takeaways? We have mentioned that the major differences or major changes are the increase from 10% to 30% or 25% in the tax rates for chargeable gains. Okay, strategic planning is essential to ensure that all your gains are not being eroded by tax. Also, the tax efficient vehicles, which are collective investment schemes of mutual funds and government bonds, offer some respites in respect of taxes or chargeable gains. Then compliance is not negotiable. We have to make sure that the compliance with the tax laws and provisions are abided with to avoid any penalties that may arise from non-compliance. So that's the bits on the presentation. So thank you for listening. This should be time for contributions and questions. Tiger, can you hear me?
Very well, Mr. Sonyaolu. Very well. Awesome. I must say thank you so much. This has been very informative, very educative, very strategic, very timely. And I think there's no better time than this for us to have had this engagement. Awesome. In fact, I feel like clapping over here for the insights that you have provided. Thank you so much. Again, for those of us who may have joined late, Mr. Adeboye Sonyaolu is a chartered accountant and a tax advisor with over 15 years, robust experience in tax matters. and he currently works with Crestin Pedabo. And for us at FCSL, we have put this together particularly for our esteemed clients to provide some insights into what you can do regarding your investments, your portfolio, your wealth ahead of 2026 with regard to the capital gains tax. And I'm sure for the last 30 minutes, Mr. Sonyaolu has provided us with deep insights and strategies on what we can do to be able to manage our wealth better ahead of what's coming for us for 2026. Again, I like to say for those of us who have questions, we can make use of the questions and answers tab to drop our questions. At some point within the next 15 minutes, we'll be taking questions and answers. Also, we will be able to take questions from those who may want to ask live. What you need to do is just to raise your hands. Your digital hands now, your show of hands, and we'll be able to unmute you to ask your questions. Okay, I have a few questions here, Mr. Deboye, which I'd like to take forward. Okay, first of all, let me start with this one. This person is saying, thank you for the presentation and explanations. He's saying, how does commercial papers and their maturities fit into the capital gains tax?
Okay, thank you. You said, how does commercial papers and their maturities
fit into the capital gains tax?
Okay, unfortunately, any gains you make from such securities are now liable to CGT. Previously, with the Finance Act, they were not, but now they are now liable to CGT. The only securities that are exempt now are FGM bonds and state government bonds.
Interesting. Okay. This person is asking, if you have mutual funds domiciled abroad in USD, will the CGT impact on dividends received?
Okay, firstly, Nigerians are liable to tax on their worldwide income. So if you have any income from abroad that you are earning as a Nigerian, you'll be liable to tax. But the condition is, now you have mentioned a mutual fund abroad that you earn dividends from. So where you earn dividends from outside Nigeria and you bring in the dividends through government-approved channels, being authorized banks, then such will not be liable to further tax. So your dividends brought in from abroad will not be liable to further tax in Nigeria.
Awesome. Thank you. So yeah, this person is asking, he's saying, how exactly does the relief option from losses apply? Is there a rebate?
Okay, so in a particular year, say 2025, if you have gains that you have made on stock A, say 100 million gains, and you have losses that you have also incurred on stock B, what it then means is that your gains of 100 million naira minus your losses of 20 million naira, then the balance of 80 million naira will be liable to chargeable gains. Previously, before the Finance Act, it was only gains that will be taxed. You don't have the option of recouping your losses from your gains before the balance is being taxed.
Awesome. Again, just to buttress, so this speaks to where you talked about having proper documentation. Proper documentation. I like to emphasize that. So going into 2026 as an investor in the equities market, you must ensure proper and accurate documentation of all of your transactions to be able to nil off where you have losses against your profits. If I'm correct, Mr. Sonyaolu.
Yes, very, very correct.
Thank you. Thank you so much. So yeah, this person is saying, so the general outlook for Nigeria stock market next year I don't know what research gives you that, but let me just read it. He's saying the general outlook for the Nigerian stock market next year is very bleak, right? Okay, he's asking a question. Is it very bleak? The general outlook for the stock market next year, is it very bleak? That's one part of the question. Then he went on to ask, what if your trade and gains exceed 150 million and 10 million in a year? Will it still be subject to tax even when you have not exited the markets for other asset classes? Then the third is, at what point will the tax charge crystallize? I think three in one question. I'll take it again. First of all, by virtue of this capital gains tax, do we think the outlook for the Nigerian stock market in 2026 is bleak?
Bleak, like
Bleak. Yeah,
uncertain.
yeah, more like,
Well,
yeah, in the month of November, we've seen the market do a record loss, a 5-year record loss that we've never seen before. Obviously, investors believe that it's as a result of the capital gains tax, the uncertainties around it. So going into 2026, are we likely to see a continuation of this downward trend in the equities market?
well, I will leave that to the investment advisors. Okay.
Awesome.
Yes,
That's our job, honestly. Yes.
yes, I will leave that to the investment advisors to because it's related to your outlook and expectation of
For
the market.
2026. Yeah.
Yes. But
Interesting.
with effect with the question on the threshold of 150 million, whether uh, it will be taxable if you have made a gain of over 10 million naira relating to proceeds of more than 150 million naira, and you have not exited the market, whether it will be taxable or not. So the question is no, it will not be taxable. So far, you have not exited. It is only when you exit without reinvestment that capital gains tax, that chargeable gains will be liable to tax. Okay, so the idea behind it is you have to reinvest to defer paying any taxes. Okay, and it's also to maintain the Nigerian Stock Exchange, okay, to continue the development, the promotion of the capital market, such that as much as you are investing, no tax is liable on your gains. So that's the answer to the second question. I can't remember the
Awesome.
third one.
Awesome. Yes. Okay. I think you've also answered it, because the third one was, at what point will the tax charge crystallize? And I think you've already spoken to that. It's already at the point of exit.
Yes.
All right. Thank you. Thank you, Mr. Sonia Olu. Okay, so just some questions. I think I'm seeing a lot of questions around the commercial paper. I know you mentioned that commercial papers would attract CGT, but the fact is that commercial papers currently are subject to a 10% withholding tax, which is deducted at source. So here they're asking, it's not clear if after the withholding tax deduction, investors will still need to further declare it in their filing, and will it also be subject to this CGT?
Yes, it is also liable to tax. So the bottom line is the tax rate for corporate entities is 30%, while the tax rate for individuals is between 0 and 25%. Now, commercial papers, what you earn on commercial papers is interest. Okay, so if withholding tax is being deducted at source at 10%, it therefore means that any extra, by the time you include your commercial papers in your total income, you may be likely to pay the difference as tax. But there is a provision in the tax law, the Nigerian Tax Act, that exempts from individuals interests from short-term securities. okay, after it has suffered tax at source. So if we agree that commercial papers can be classified as a short-term security, then the 10% withheld at source will no longer be liable to additional tax.
Great. Okay, thank you for that clarification. So yeah, this person is asking, how does capital gain tax apply to cross deals, related party transactions, or intra-group transfers?
Can you come again?
So the person is asking, he says, how does capital gain tax apply to cross deals, related party transactions? That is, I think this, yeah, related party transactions or intra-group transfers. How does capital gains tax apply? Transactions between maybe company interrelated transactions on the equity side of the market, you are doing a cross deal between two accounts. How does CGT apply? Will it apply? If it does, how will it?
Okay, so what is important to note is that um, whether it is related party or not, where there is a transfer or sale, okay, and there is a chargeable gain, then CGT will apply.
Apply.
The only difference is that with related party, the tax authority would ensure that the transfers are done at arm's length. Okay, if the transfers or the transaction is not at arm's length, then there will be adjustments by the tax authority to make sure that the prices at which the transfers were made are at arm's length, and the the parties to the transaction will be liable to additional tax if those transactions are not at arm's length.
Awesome. Thank you. Okay, so this person is saying, how can individuals go about filing their tax returns? And in a case where these returns are not filed with the tax, and in the case where these returns are not filed, will the tax deductions be at the tax agency's discretion? How can individuals go about filing their tax returns? I know you kind of spoke to that during the presentation, and is now saying, in case where individuals obviously do not have these documents, they don't file, will the tax deductions be made at the discretion of the tax agency? What will
Okay,
happen?
so number one, every individual is supposed to file their personal income tax returns by 31st of March of every year. So 31st of March next year, you're supposed to file your income tax returns on profits or your salaries or your gains made in 2025. Now, the filing is done by, previously it was physical filing where you obtain a form and file physically. But in Lagos State and other states now, this can be done online. First, you have to register with the relevant tax authority where you reside. Then you fill the forms, you include your incomes and your deductions. Then the taxes will be calculated and you pay your taxes. But if you don't file, if you don't include your deductions, the tax authority may not know that you have losses or you have incurred expenses that needed to be included in your filing. Most times, when this happens, the tax authority will just assume only your income and tax your income without consideration of your cost. So it is your duty to also disclose your expenses and other costs that you have incurred in your businesses or your chargeable gains.
Great. Thank you. It is your duty to provide all of those documentations, provide relevant information to avoid being excessively taxed based on the available information to the tax authority. Okay, we have someone raising their hands. Kingsley, right? Okay, Kingsley, you can please unmute and ask your question.
Good afternoon, everyone. I don't know if you
Good
can hear me.
afternoon. Yes, we can. Thank you.
Okay. I don't know if I missed it, but two things concern me. Number one is 2026 filing by individuals supposed to be done by 31st of by 31st of March, right? But what we are filing by 31st of March is 2025 income. So does that mean that the 2025 income that we're filing in 2026, is it going to be, is it the 2025 tax laws that is going to be applied, or is it the 2026 tax law that starts from January 1st that is going to be applied? I don't know if you understand what I'm asking. So when you are filing in 2026, are you going to be applying the tax laws that was there when you were doing business in 2025 over and against, or are you going to be applying this new tax law that starts in 2026, even though your income was from 2025? I don't know if that's my question is clear, if you understand my challenge.
Yes, it's clear, Kingsley. Thank you. So we mentioned this earlier when we were talking about the retrospective application. Okay, we have heard that the new tax laws will take effect from January 2026. But what is not clear is whether it will be applied retrospectively, that is backwards or forwards. And I also mentioned that we expect the government to come to our rescue to make clarifications in this regard. If it is applied retrospectively, uh, taxpayers are saying that's not fair. I would have structured my businesses, my transactions, if I had known that these tax laws exist. But they did not exist at the time when I was doing my businesses. So it's unfair for the tax law to now apply prospectively to what to the business I've done in the past. And there has been some challenge legally to this retrospective application. Some companies have taken the FRS to court to say that you cannot tax me retrospectively. The tax law was enacted after I have conducted my businesses. So why would you tax me in such a manner? And the judgment was in favor of the taxpayer. So we expect guidelines and clarifications to actually come out in this area to confirm whether 2026 is going to be the first year, transactions in 2026 are going to be the first year that the tax law will apply to, and not 2025. Hope that clarifies.
Kingsley, I hope that clarifies your question. I believe it suffices answers your question.
Yes, it does. I believe we'll just wait for the government then.
Yes,
Yes, it does.
absolutely. Like we mentioned earlier, it's part of some of the gray areas which we believe the government will provide some clarity on before 2026 rolls in. I think we've had a good time. We're supposed to be here for at least an hour. I think we'll just do another 3 minutes so we can round off. Once again, we'd like to appreciate everyone for joining, and I'm sure it's been a worthwhile experience thus far. One more question here, Mr. Sanyolu. So this person just requires some clarity on the 150 million sales proceeds and 10 million income. So he's saying, is the 150 million sales proceeds annual? That's one part of the question. Then he's saying also, if it's 150 million, but the income is not up to 10 million, will he still be taxed?
Okay, firstly, the 150 million threshold is annual. It's a 12-month period. So any proceeds or any transactions you make in a 12-month period that is less than 150 million is exempt. And the exemption, the gain the threshold for the gain is less than or equal to 10 million naira. So if also your proceeds does not is not higher than 10 million naira, then it's also exempt. So both conditions need to be met for you to satisfy the exemption.
Okay, thank you. Thank you so much. Another question here. Someone is asking, should investors with fixed deposits be advised to liquidate their fixed deposit before December 31st and reinvest in 2026?
So fixed deposits does not attract CGT.
Yes.
It doesn't attract CGT. It's only it doesn't attract CGT. So it's only withholding tax that applies when you have a fixed deposit with the bank. When they're paying you interest, they will deduct withholding tax at 10%. That is the final tax. It doesn't suffer other taxes. It doesn't suffer additional tax.
Thank you. Thank you for that. Thank you for that. I think it's been worthwhile so far. I'd like to thank everyone who has joined this call, and I'm confident that some significant insights have been provided in the course of this engagement. Again, I like to appreciate Mr. Adeboye Sonyaolu, who is a tax expert with Creston Pedabo, for being on this engagement this morning. Now it's midday already, and for all of the wonderful insights he's provided. Again, 2026 is on our heels. For us at FCSL, we are committed to ensuring that our clients, our prospects, are armed with every information that would ensure that their wealth are preserved and they are able to maximize the opportunities that would come in the capital markets come 2026. And so that's why we have had this engagement this morning. Mr. Sonyaolu has been able to provide us with some strategies which we think will be beneficial to us in ensuring that our portfolio, to a very large extent, is what I say shielded against these new tax reforms. And again, just to reiterate some of the things he has said, again, for us at FCSL, we are well positioned to advise and to guide you as we journey through 2026. But just to give some highlight on some of the things he said, what you can do, what you can begin to start thinking of ahead of 2026, you must begin to consider timing of the disposal of your equities portfolio. If you intend to do that in 2026, timing of your disposal is very critical. Also looking at your portfolio, you must begin to consider diversification, including some tax exempt instruments. He highlighted bonds, federal government bonds, collective investment schemes, which are also very critical. Also, if you're investing in the equities market, you must also begin to look at high-paying dividend stocks, which are very critical. And also managing documentation, which is also very important to ensure you maximize harvesting your tax losses. So if you've not been keeping adequate documentation of your transactions prior to now, come 2026, you must begin to do that effectively and efficiently. And also you must begin to consider, I like that one interestingly, and I think Mr. Adeboye will talk more on that. You talked about considering spreading your investments across several parties. I don't know if you have, maybe within 1 minute, if you can just shed more light on that, how would that be beneficial? Considering spreading your investment across several parties. Yeah.
Tiger, like you said, let's talk more on that outside this call.
Beautiful. So I like that. So if you would like to learn more of that, for us at FCSL, we're very much available to guide and to advise you on that. On behalf of the entire team at FCSL Asset Management, we'd like to say thank you to everyone who has joined this engagement this morning. We are committed to providing distinctive service in the financial and in the Nigerian capital market. Our licenses cuts across issuing house, financial advisory, broker dealer, and fund and portfolio management. Again, Mr. Adeboye, thank you so much. We cannot We cannot be grateful enough. It's been exciting. It's been insightful, I must confess. And on behalf of FCSL, all of our clients and everyone on this call, we appreciate you greatly, and we look forward to more engagements. Thank you so much. Any
Thank you,
final
Tiger.
words, Mr. Sanyolu? Yeah.
Thank you. Thank you very much, Tiger. We appreciate the invite, and we expect that more of these collaborations would continue. Of course, remember, we are here for your tax needs. If you need advisory, clarifications, and structuring your investments, and so on, reach out to us. We would help provide necessary solutions. Thank you very much.
Thank you. Once again, thank you, everyone. Let's have a beautiful rest of the day and a great weekend ahead. God bless you.